I'm a little jealous of what Marcos just did because he got to talk about stocks. And most of what we do, most of our days are spent thinking about companies, analyzing companies at BWM too. But maybe it's to your advantage that I'm not going to do it because I'd repeat a lot of the things that Marcos said about value investing in general. What I'm going to do is I'm going to focus on a high-level topic. And the reason is my colleague Urban Müller, who you've already met in the beginning, did some research which was so interesting that for all of us here who are interested in value investing, the conclusions are something you'll want to hear. And if you're not interested in value investing, there are conclusions that you should hear. So, as you know, maybe you don't know, our long-term track record is good. We've been hitting new highs here, the Classic Global Equity Fund, which has been in business since 1997, and we've had a wonderful run since the end of 2024. Things are finally working. So the question is, can it last? And thanks to Urban's research, we're more than convinced that it can last. Now, what he did was he took the Fama and French data and looked at it in a new way. As you know, Fama French had a data set for their seminal 1992 paper, which is available online and has been updated monthly since then. And one of the things you can do with it is you can sort it into 5 categories. If you take the US data by the cheapest, that would be the ones in green, so that's the cheapest 20% of stocks, up to the most 20% of stocks, so they're the most expensive. They're hot, that's why I colored them red. In Europe, the data set goes back to about 1990. Here, Fama and French split it into thirds, and all of the sorts are based on either price cash flow, price book, or price earnings. So you've got valuation criteria that differentiate these groups. And it doesn't really matter which one you take. The conclusion turns out to be the same. So what did we do? Urban asked 2 questions. How does the market cap, so the weight of each of these 5 quintiles or 3/3, how does that move over time? Is there any pattern that we can recognize, any rule to it? And then the second question is, do these weights at any particular point in time, so let's say that they're high as they are today, does that tell us anything about the future? Well, here's the US quintile, the 2 quintiles from the US, the most expensive one in red, as a percentage of market cap. So those 20% of stocks now account for over 60% of the market cap in the US. And then the cheapest quintile, which is the area where we fish. And as you can see, there's clearly a pattern here. Mean reversion is at work. We have peaks, we have valleys, as you would expect. And right now we're at a high point, and you would expect that at some point that's going to come down. What does that mean in terms of future performance? Oh, and here's Europe as well. Because we're sorting the world into thirds, the difference isn't that big, and also we started in 1990, so the most expensive third is better. It's stronger right now in terms of market cap, but it's not as an egregious situation as in the United States. Okay, so let's look at this second question. What happens at each particular point? And the way I'm going to show you is I'm going to take the market shares of the most expensive quintile, and I will show you what the future performance was at each point in time. And I'm going to put these bubbles on top of each point in time. So we'll look 3 years ahead and say, from that point on, how did we do 3 years later or 5 years later? And if the bubble is solid colored, value outperformed growth. And if the bubble is white, as the one on the bottom right is, then growth outperformed value. And the size of the bubble says by how much. And here's what the data looks like if we look 5 years ahead at each point. So you see on the far right, 5 years haven't passed, so we don't know how it's going to turn out yet. That's why we're here, to talk about this. But history shows us that there's a clear pattern. When market concentration was high in growth stocks, performance of value in the following 5 years was very good. The pattern holds for 3-year data. That's what I show you here. It's a little less evident. And we could still say that when growth stocks are a huge part of the market, that they outperform going forward. For the other points, when market concentration isn't as high, it's not as easy to tell. Sometimes value outperforms, sometimes growth outperforms. But growth never, or almost, except in the 1920s, it never outperformed when we hit peaks. Really, really high levels of concentration as we have today. And that's an important conclusion given where we are today, which is at a very high level. Let's look at it in absolute terms. Here I'm showing you the data for the times when value outperformed, just for when value outperformed. And in green, you see the absolute return of value. And you see that there aren't very many episodes where value lost you money. Yes, in the 20s it happened, and there in the 70s, a couple of months. But most of the time, value made you money in absolute terms. Growth, however, over these periods did lose you money at some point. So the relative outperformance isn't just that value went up more, that happened too, but you actually lost money if you were invested in the most expensive stocks. Let me put some numbers around that. So what we're going to do is we're going to take this line and sort it into 5 buckets. The B1 bucket, so the lowest bucket, is all the observations where concentration was lowest. The B5 bucket is all the observations where concentration was highest. I'm just sorting it evenly. That's what those 4 lines show, that I've sorted each period into one, well, Orban sorted each period into one of these 5 buckets. And I'm going to show you the performance statistics now. So these are the relative performance statistics. The US, solid colored, Europe with the diagonal lines. And you see, when we had low growth concentration, so when we were sort of lower on that red line, value is better, but sometimes it's better, sometimes it's not. There's not a clear pattern here, I would say. But when we get to higher concentration, clearly you see that value starts to outperform very strongly. And we are in a time of high concentration. Here are the absolute returns. Value makes you money all the time. That's good. But as we saw before, so does growth under certain circumstances, not where we are today. So now here, the shameless plug for our own product. The classic funds are a value fund, so we're giving you cheap stocks. Price to book is about 1/3 of the market. Those first 3 lines are based on consensus numbers. PE, dividend, is also about 60% of the market, and the dividend yield is more than twice the market, not because we look for dividends, they're tax inefficient, so we don't really like them, but we'll take them if a company has high cash flows and a good balance sheet, it is able to pay dividends. And so this is an indication that we have a portfolio of companies that on the whole is well financed and generates cash flows. On the bottom line, you'll see our estimate of the price to intrinsic value. As Marcus Kausen, my colleague, will show you after the coffee break, we estimate an intrinsic value for every share, and we try to buy at a discount to that intrinsic value. And right now, on average, you're buying $1 or a franc's worth of value for 61 or 66 at Oppen, which on a historical basis is pretty cheap. So to sum up, value's performance should last because we do have an excessive concentration in growth stocks, and so the conditions for value outperformance are excellent, for value absolute performance are excellent, and therefore we think that value belongs in every portfolio all the time, but especially now. It's the only prudent thing to do. And now I'm going to ask Kim to come up, who's going to give you a similar talk going at this question over time from a slightly different angle, which fits beautifully with what I just said. Thanks.
Great.